The lion shows up and everyone starts running, you run with them. That does not work well in markets. In fact, you generally have to do the opposite.
In your lecture on the basics of finance and investing, you mentioned a book, Intelligent Investor by Benjamin Graham, as being formative in your life. What key lesson do you take away from that book that informs your own investing?
Sure. Actually, it was the first investment book I read. And as such, it was kind of the inspiration for my career and a lot of my life. Important book. Bear in mind, this is sort of after the Great Depression. People lost confidence in investing in markets. World War II. And then he writes this book. It's for like the average man. And basically he says that you have to understand the difference between price and value. Price is what you pay. Value is what you get. The stock market is here to serve you. And it's a bit like the neighbor that comes by every day and makes you an offer for your house. Makes you a stupid offer, you ignore it. Makes you a great offer, you can take it. And that's the stock market. And the key is to figure out what something's worth. And you have to kind of weigh it. The stock market in the short term is a voting machine. It represents speculative interests, supply and demand of people in the short term. But in the long term, the stock market's a weighing machine, much more accurate. It's going to tell you what something's worth. And so if you can divine what something's worth, then you can really take advantage of the market because it's really here to help you. And that's kind of the message of the book.
In that same way, there's a kind of difference between speculation and investing.
Yeah. Speculation is just a bit like trading crypto, short-term trading crypto. Maybe in the long run, there's intrinsic value. But many investors in a bubble going into a crash were really just pure speculators. They didn't know what things were worth. They just knew they were going up, right? That's speculation. And investing is, doing your homework, digging down, understanding a business, understanding the competitive dynamics of an industry, understanding what management's going to do, understanding what price you're going to pay. The value of anything, I would say, other than love, let's say, is the present value of the cash you can take out of it over its life. Now, some people think about love that way, but it's not the right way to think about love. Investing is about basically building a model of what this business is going to produce over its lifetime. How
do you get to the value of a thing on the stock market?
Sure.
Companies.
The value of a security is the present value of the cash you can take out of it over its life. So if you think about a bond, bond pays a 5% coupon interest rate. You get that, let's say every year or twice a year, split in half. And it's very predictable. And if it's a U.S. government bond, you're going to get it. So that's a pretty easy thing to value. A stock is an interest in a business. It's like owning a piece of a company. And a business, a profitable one, is like a bond in that it generates these coupons or these earnings or cash flow, every year. The difference with a stock and a bond is that the bond, it's a contract. You know what you're going to get as long as they don't go bankrupt and default. With a stock, you have to make predictions about the business. How many widgets are going to sell this year? How many are going to sell next year? What are their costs going to be? How much of the money that they generate do they need to reinvest in the business to keep the business going? And that's more complicated. But what we do is we try to find businesses where, with a very high degree of confidence, we know what those cash flows are going to be for a very long time. And there are very few businesses that you can have a really high degree of certainty about. And as a result, many investments are speculations because it's really very difficult to predict. What I do for a living is find those rare companies that you can kind of predict what they're going to look like over a very long period of time.
What are the factors that indicate that a company is going to be something that's going to make a lot of money, it's going to have a lot of value, and it's going to be reliable over a long period of time?
Every consumer has a view on different brands and different companies. What we look for are sort of these non-disruptible businesses, a business where you can kind of close your eyes, stock market shuts for a decade, and you know that 10 years from now, it's going to be a more valuable, more profitable company. So we own a business called Universal Music Group. It's in the business of helping artists become global artists. That's sort of the recorded music business. And it's in the business of owning music publishing rights of songwriters. I think music is forever, right? Music is a many thousand-year-old part of the human experience. And I think it will be, thousands of years from now. And so that's a pretty good backdrop to invest in a company. And the company basically owns a third of the global recorded music, the most dominant sort of market share in the business. They're the best at taking an artist who's 18 years old, who's got a great voice, and helping that artist become a superstar. And that's a unique talent. And the result is the best artists in the world want to come work for them. But they also have this incredible library of, the Beatles, the Rolling Stone, U2, etc. And then if you think about what music has become, it used to be about records and CDs and 8-track tapes. And it was about a new format, and that's how they drive sales. And it's become a business about streaming. And streaming is a lot more predictable than selling records, right? You can sort of say, okay, how many people have smartphones? How many people are going to have smartphones next year? There's a kind of global penetration over time of smartphones. And you pay, call it $10, $11 a month for a subscription or last for a family plan. And you can kind of build a model of what the world looks like and predict the growth of the streaming business, predict what kind of market share Universal is going to have over time. You can't get to a precise view of value. You can get to an approximation. And the key is to buy at a price that represents a big discount to that approximation. And that gets back to Ben Graham. Ben Graham was about he invented this concept of margin of safety, right? You want to buy a company at a price that if you're wrong about what you think it's worth, and it turns out to be worth 30% less, you paid a deep enough discount to your estimate that you're still okay. Investing, a big part of investing is not losing money. If you can avoid losing money and then have a few great hits, you can do very, very well over time. There are all kinds of risks in every business. This is one that I think has a very high degree of persistence. And I can't envision a world where beyond streaming, in a sense. Now, you may have a Neuralink chip in your head instead of a phone, but the music's going to come in a digitized kind of format. You're going to want to have an infinite library that you can walk around in your pocket or in your brain. It's not going to matter that much if the form factor, the device changes. It's not really that important whether it's Spotify or Apple or Amazon that are providers. I think the value is really going to reside in the content owners, and that's really the artists and the label. But that's sort of one example. Another example could be just, the restaurant industry. You look at businesses like a McDonald's, right? It's whatever, the company's like a 1950 vintage business. And here we are, it's, 75 years later. And you can kind of predict what it's going to look like over time. And the menu's going to adjust over time to consumer tastes. But I think the hamburger and fries is probably forever.
The Beatles, the Rolling Stones, the hamburger and fries are forever. What's the actual process you go through? The process of figuring out what the value of a company is. Like, how do you do the research?
So Chipotle, what attracted us initially, the stock price dropped by about 50%. Great company, great concept. Athletes love it. Consumers love it. Healthy, sustainable, fresh food made in front of your eyes. But ultimately, the company's lacking some of the systems and had a food safety issue. Consumers got sick, almost killed the brand. But the reality of the fast food, quick service industry is almost every fast food company has had a food safety issue over time. And the vast majority have survived. And we said, look, such a great concept. But their approach was far from ideal. We start with usually reading the SEC filings. Companies file a 10K or an annual report. They file these quarterly reports called 10Qs. They have a proxy statement which describes kind of the governance, the board structure. Conference call transcripts are publicly available. It's kind of very helpful to go back 5 years and kind of learn the story. Here's how management describes their business. Here's what they say they're going to do. Then you can follow along to see what they do. It's like a historical record of how competent and truthful they are. It's a very useful device. And then, of course, looking at competitors and thinking about what could dislodge this company. If it's an industry we don't know well, we know the restaurant industry really well. Music industry, we'll talk to people in the industry. We'll try to understand the difference between publishing and recorded music. We'll look at the competitors. We'll read books. I read a book about the music industry or a couple books about the industry. It's a bit like a big research project. And these so-called expert networks now. And you can get pretty much anyone on the phone, and they'll talk to you about an aspect of the industry that you don't understand, want to learn more about. Try to get a sense. Public filings of companies generally give you a lot of information, but not everything you want to know. And you can learn more by talking to experts about some of the industry dynamics, the personalities. You want to get a sense of management. I like watching podcasts. If a CEO were to do a podcast or a YouTube interview, you get a sense of the people. The kind of business we're looking for is kind of business everyone should be looking for, right? A great business. It's got a long-term trajectory of growth, even beyond the foreseeable distance, right? Those are the kind of businesses you want to own. You want businesses that generate a lot of cash. You want businesses you can easily understand. You want businesses with these sort of huge barriers to entry where it's difficult for others to compete. You want companies that don't have to constantly raise capital. And these are some of the great businesses of the world. But people have figured out that those are the great businesses. So the problem is those companies tend to have very high stock prices, and the value is generally built into the price you have to pay for the business. So we can't earn the kind of returns we want to earn for investors by paying a really high price. Price matters a lot. You can buy the best business in the world, and if you overpay, you're not going to earn particularly attractive returns. We get involved in cases where a great business has kind of made a big mistake, or you've a company that's kind of lost its way, but it's recoverable. We buy from shareholders who are disappointed, who've lost confidence, selling at a low price relative to what it's worth if fixed, and then we try to be helpful in fixing the company.
You said barriers to entry. How do you know if there's a type of moat protecting from competitors stepping up to the plate?
The most difficult analysis to do as an investor is kind of figuring out how wide is the moat, how much at risk is the business to disruption. And we're in, I would say, the greatest period of disruptability in history, right? Technology. A couple of 19-year-olds can, leave whatever university, or maybe they didn't even go in the first place. They can raise millions of dollars. They can get access to infinite bandwidth storage. They can contract with engineers in low-cost markets around the world. They can build a virtual company, and they can disrupt businesses that seem super established over time. And then on top of that, you have major companies with multi-trillion-dollar market caps working to find profits wherever they can. And so that's a dangerous world, in a way, to be an investor. You have to find businesses that it's hard to foresee a world in which they get disrupted. And the beauty of the restaurant business, and our best track record is in restaurants. We've never lost money. We've only made a fortune, interestingly, investing in restaurants. A big part of it's a really simple business. And if you get Chipotle right and you're at 100 stores, it's not so hard to envision getting to 200 stores and then getting to 500 stores. And the key is maintaining the brand image, growing intelligently, having the right systems. Now, when you go from 100 stores to 3,500 stores, you have to know what you're doing. there's a lot of complexity. If you think about your local restaurant, the family's working in the business, they're watching the cash register, and you can probably open another restaurant across town. But there are very few restaurant operators that own more than a few restaurants and operate them successfully. And the quick service business is about systems, that a stranger who doesn't know the restaurant industry can come in and enter the business and build a successful franchise. Now, Chipotle is not a franchise company. They actually own all their own stores. But many of the most successful restaurant companies are franchise models, like a Burger King, a McDonald's, Tim Hortons, all these various brands, Popeyes. And there it's about systems. But the same systems apply whether you own all the stores and it's run by a big corporation, or whether the owners of the restaurants are sort of franchisees, local entrepreneurs.
So if the restaurant has scaled to a certain number, that means they've figured out some kind of system that works.
Yes.
It's very difficult to develop that kind of system. So that's a moat.
A moat is you get to a certain scale and you do it successfully, and the brand is now understood by the consumer. And what's interesting about Chipotle is what they've achieved is difficult. They're not buying frozen hamburgers getting shipped in. They're buying fresh, sustainably sourced ingredients. They're preparing food in the store. That was the first. Quality of the product at Chipotle is incredible. It's the highest quality food you can get. You can get a serious dinner for under $20 and eat really healthfully and very high quality ingredients. And that's just not available anywhere else. And it's very hard to replicate and to build those relationships with farmers around the country. It's a lot easier to make a deal with one of the massive food producers and buy your pork from them than to buy from a whole bunch of farmers around the country. That is a big moat for Chipotle, very difficult to replicate.
You were talking about moats, and this kind of reminded me of Alphabet, parent company.
Sure, it's a big position for us.
It's interesting that you think that maybe Alphabet fits some of these characteristics. It's tricky to know with everything that's happening in AI. It's interesting that you think that there's a moat. What's your analysis of Alphabet? Why are you still positive about it?
It's a business we've admired as a firm for 15 years, but rarely got to a price that we felt we could own it because, again, the expectations were so high and price really matters. And really the sort of AI scare, I would call it. Microsoft comes out with ChatGPT. They do an amazing demonstration. People are like, this most incredible product. And Google, working on AI even earlier, obviously the Microsoft was behind in AI. That was really their ChatGPT deal that gave them a market presence. And then Google does this fairly disastrous demonstration of Bard. And the world says, oh my God, Google's fallen behind in AI. AI is the future. Stock gets crushed. Google gets to a price around 15 times earnings, which for a business of this quality is an extremely, extremely low price. And our view on Google, one way to think about it, when a business becomes a verb, that's usually a pretty good sign about the moat around the business. You open your computer and you open your search, and very high percentage of the world starts with a Google page in one line where you type in your search. Google advertising search YouTube franchise is one of the most dominant franchises in the world. Very difficult to disrupt, extremely profitable. The world is moving from offline advertising to online advertising, and that trend, I think, continues. Why? Because you can actually see whether your ads work. They used to say about advertising, you spend a fortune and you just don't know which 50% of it works, but you just sort of spend the money because ultimately that's going to bring in the customer. And now with online advertising, you can see with granularity which dollars I'm spending. When people click on the search term and end up buying something, it's a very high return on investment for the advertiser, and they really dominate that business. Now, AI, of course, is a risk. If all of a sudden people start searching or asking questions of ChatGPT and don't start with the Google search bar, that's a risk to the company. And so our view, based on work we had done and talked to industry experts, is that Google, by virtue of the investment they've made, the time, the energy that people put into it, we felt their AI capabilities were, if anything, potentially greater than Microsoft ChatGPT, and that the market had overreacted. And because Google is a big company, global business, regulators scrutinize it incredibly carefully, they couldn't take some of the same liberties a startup like OpenAI did in releasing a product. And I think Google took a more cautious approach in releasing an early version of Bard in terms of its capabilities. And that led the world to believe that they were behind. And we ultimately concluded they're tied or ahead, and you're paying nothing for that potential business. And they also have huge advantages. Think of all the data Google has, like the search data and all the various applications, email and otherwise. It's an incredible data set. So they have more training data than pretty much any company in the world. They have incredible engineers. They have enormous financial resources. So that was kind of the bet. And we still think it's probably the cheapest of the big 7 companies in terms of the price you're paying for the business relative to its current earnings. It also is a business that has a lot of potential for efficiency. Sometimes when you have this enormously profitable, dominant company, all of the technology companies in the post-March 20 world grew enormously in terms of their teams, and they probably overhired. And so you've seen some, the Facebooks of the world, and now even Google starting to get a little more efficient in terms of their operation. So low multiple for their business. One way to think about the value of the business is the price you pay for the earnings, or alternatively, what's the yield? If you flip over the price over the earnings, it gives you kind of the yield of the business. So a 15 multiple is almost a 7.5% yield, and that earnings yield is growing over time as the business grows. compared to what you can earn lending your money to the government, 4%, that's a very attractive going in yield. And then there's all kinds of what we call optionality in all the various businesses and investments they've made that are losing money. We've got a cloud business that's growing very rapidly, but they're investing basically 100% of the profits from that business in growth. So you're in that earnings number, you're not seeing any earnings from the cloud business. And, they're one of the top cloud players. So very interesting, generally well-managed company with incredible assets and resources and dominance. Has no debt, it's got a ton of cash. Pretty good story.
Is there some more risk introduced by the possibilities of AI?
Absolutely. That's a great question. Investing is about finding companies that can't be disrupted. AI is the ultimate disruptible asset or technology. And that's what makes investing treacherous, is that you own a business that's enormously profitable. Management gets, if you will, fat and happy. And then a new technology emerges that just takes away all their profitability. And AI is this incredibly powerful tool, which is why every business is saying, how can I use AI in my business to make us more profitable, more successful, grow faster, and also disrupt or protect ourselves from the incomings. It's a bit like, Buffett talks about a great business like a castle surrounded by this really wide moat, but you have all these barbarians trying to get in and steal the princess. And it happens. Kodak, for example, was an amazing, incredibly dominant company until it disappeared. Polaroid, this incredible technology. And that's why we have tended to stay away from companies that are technology companies, because technology companies, generally, the world is such a dynamic place that someone's always working on a better version. And, Kodak was caught up in the analog film world, and then the world changed.
You mentioned management. How do you analyze the governance structure and the individual humans that are the managers of a company?
As I like to say, incentives drive all human behavior. And that certainly applies in the business world. So understanding the people and what drives them and what the actual financial and other incentives of a business are a very important part of the analysis for investing in a company. One great way to learn about a business is go back a decade and read everything that management has written about the business and see what they've done over time. Conference calls are relatively recent. When I started in the business, there weren't conference call transcripts. Now you have a written record of everything management has said in response to questions from analysts at conferences and otherwise. You learn a lot about people by listening to what they say, how they answer questions, and ultimately their track record for doing what they say they're going to do. Do they underpromise and overdeliver? Do they overpromise and underdeliver? Do they say what they're going to do? Do they admit mistakes? Do they build great teams? Do people want to come work for them? Are they able to retain their talent? And then part of it is, how much are they running the business for the benefit of the business? How much are they running the business for the benefit of themselves? Very senior management matters enormously. We use the Chipotle example. Steve L's great entrepreneur. Business got to a scale he really couldn't run it. The company recruited a guy named Brian Nickel, and he was considered the best person in the quick service industry. He came in and completely rebuilt the company. Actually, we moved the company. Chipotle was moved to California. And sometimes one way to redo the culture of a company is just to move it geographically. And then you can kind of reboot the business. But a great leader has great followership. Over the course of their career, they'll have a team they've built that will come follow them into the next opportunity. But the key is, really the top person matters enormously. And then it's who they recruit. You recruit an A+ leader and they're going to recruit other A-type people. You recruit a B leader, you're not going to recruit any great talent beneath them.
You mentioned Warren Buffett. You said you admire him as an investor. What do you find most interesting and powerful about his approach?
Most of what I've learned in the investment business, I've learned from Warren Buffett. He's been my great professor of this business. My first book I read in the business was The Ben Graham Intelligent Investor. But fairly quickly, you get to learn about Warren Buffett. And I started by reading the Berkshire Hathaway annual reports. And then I eventually got the Buffett partnership letters that you could see, which are an amazing read to go back to the mid-1950s and read what he wrote to his limited partners when he first started out and just follow that trajectory over a long period of time. So what's remarkable about him is, one, duration, right? He's still at it at 93. Two, takes a very long-term view. But a big thing that you learn from him, investing requires this incredible, dispassionate, unemotional quality. You have to be extremely economically rational, which is not something you learn in the jungle. If you think about surviving the jungle, the lion shows up and everyone starts running, you run with them. That does not work well in markets. In fact, you generally have to do the opposite, right? When the lemmings are running over the cliff, that's the time where you're facing the other direction and you're running the other direction, i.e. you're stepping in, you're buying stocks at really low prices. Buffett's been great at that and great at teaching about what he calls temperament, which is this sort of emotional or unemotional quality that you need to be able to dispassionately look at the world and say, okay, is this a real risk? Are people overreacting? People tend to get excited about investments when stocks are going up and they get depressed when they're going down. I think that's just inherently human. You have to reverse that. You have to get excited when things get cheaper and you got to get concerned when things get more expensive. I think it's something you kind of learn over time. A key success factor is you want to have enough money in the bank that you're going to survive, regardless of what's going on with volatility in markets. People who, one, you shouldn't borrow money. So if you borrow money, you own stocks on margin, markets are going down, and you have your livelihood at risk, it's very difficult to be rational. So key is getting yourself to a place where you're financially secure. You're not going to lose your house, right? That's kind of a key thing. And then also doing your homework. Stocks can trade at any price in the short term. And if you know what a business is worth, and you understand the management, you know it extremely well, it doesn't bother you when a stock price goes down, or it has much less impact on you because you know, as Mr. Graham said, in the short term, the market's a voting machine. You have a bunch of lemmings voting one direction. That's concerning. But if it's a great business, doesn't have a lot of debt, and people are going to just listen to more music next year than this year, you know you're going to do well. So it's some combination of being personally secure and also just knowing what you own. And over time, you build calluses, I would say. I'm a pretty emotional person, or I feel pretty strong emotions, but not in investing. I'm remarkably immune to kind of volatility. And that's a big advantage. And it took some time for me to develop that.
So you weren't born with that, you think?
No.
So being emotional, you want to respond to volatility.
Yeah. You can learn a lot from other people's experience. It's one of the few businesses where you can learn an enormous amount by reading about other periods in history, following Buffett's career, the mistakes he made. If you're investing a lot of capital, every one of your mistakes is going to be big, right? So we've made big mistakes. The good news is that the vast majority of things we've done have worked out really well. That also gives you confidence over time. But because we make very few investments, we own 8 things today or 7 companies that matter. If we get one wrong, it's going to be big news. And so the other nature of our business you have to be comfortable with is a lot of public scrutiny, a lot of public criticism, and that requires some experience. Call it that. The only person who can cause you more harm than a thief with a dagger is a journalist with a pen.
Is there some general advice from the things you've been talking about that applies to everyday investors?
Sure. Never invest money you can't afford to lose, where if you lost this money, you lose your house, etc. So being in a place where you're investing money that you don't care about the price in the short term. It's money for your retirement, and you take a really long-term view. I think that's key. Never investing where you borrow money against your securities. The markets offer you the opportunity to leverage your investment. And in most worlds, you'll be okay, except if there's a financial crisis or, a nuclear device gets detonated, God forbid, somewhere in the world, or there's an unexpected war, or, someone kills a leader unexpectedly. Things happen that can change the course of history, and markets react very negatively to those kinds of events. And you can own the greatest business in the world, trading for $100 a share, and next moment it could be 50. As long as you don't borrow against securities, you own really high quality businesses, and it's not money that you need in the short term, then you can actually be thoughtful about it. And that is a huge advantage. The vast majority of investors, it seems, tend to be the ones that panic in the downturns, get over-elated when markets are doing well. Buffett is the ultimate long-term thinker. And just the decisions he makes, the consistency of the decisions he's made over time and fitting into that sort of long-term framework is a very educational, let's put it that way, for learning about this business.
You mentioned 8 companies, but what do you think about mutual funds for everyday investors that diversify across a larger number of companies?
I think there are very few mutual funds. There are thousands and thousands of mutual funds. There are very few that earn their keep in terms of the fees they charge. They tend to be too diversified and too short-term, and you're often much better off just buying an index fund. If you look carefully at their portfolios, they're not so different from the underlying index itself, and you tend to pay a much higher fee. Now, all of that being said, there's some very talented mutual fund managers. Will Danoff at Fidelity's had a great record over a long period of time. The famous Peter Lynch, Ron Barron, another great long-term growth stock investor. So there's some great mutual funds, but I put them in the handful versus the thousands. And if you're in the thousands, I'd rather someone bought just an index fund, basically.
What would be the leap for an everyday investor to go to investing in a small number of companies, like 2, 3, 4, 5 companies?
I even recommend for individual investors to invest in, a dozen companies. You don't get that much more benefit of diversification going from a dozen to 25 or even 50. Most of the benefits of diversification come in the first, call it 10 or 12. And if you're investing in businesses that don't have a lot of debt, they're businesses that you can understand yourself. You understand, actually, individual investors did a much better job analyzing Tesla than the so-called professional investors or analysts, the vast majority of them. So if it's a business you understand, if you bought a Tesla, you understand the product and its appeal to consumers. It's a good place to start when you're analyzing a company. So I would invest in things you can understand. That's kind of a key. You like Chipotle, you understand why they're successful. You can go there every week and you can monitor, is anything changing? How are these new, how's chicken al pastor? Is that a good upgrade from the basic chicken? The drink offerings improving, the store is clean. I think you should invest in companies you really understand. Simple businesses where you can predict with a high degree of confidence what it's going to look like over time. And if you do that in a not particularly concentrated fashion and you don't borrow money against your securities, you'll probably do much better than your typical mutual fund.
Yeah, it's interesting. Consumers that love a thing are actually good analysts checklists of that thing, or I guess a good starting point.
And by the way, there's much more information available today. When I was first investing, literally we had people faxing us documents from the SEC filings in Washington, D.C. Now everything's available online. Conference call transcripts are free. AI, you have unlimited data, all kinds of message boards and Reddit forums and things where people are, sharing advice. And everyone has their own, by virtue of their career or experience, they'll know about an industry or a business. I would take advantage of your own competitive advantages.
You guys know by now that I'm a firm believer that the borrower is slave to the lender, because your most powerful wealth building tool is your income. And when you haven't committed your income in the form of payments to everybody else, you can invest it and become wealthy. Really. The average car payment in America today is $503. That's just cray-cray. That's nutty. If you invest $500 in a decent growth stock mutual fund from age 30 to age 70, you'll have over $5 million. That one thing will make you worth $5 million. Isn't that amazing? And so I've become known for getting people out of debt, and it changes your life. It changes your family tree. It changes your retirement. You retire with dignity. You don't have to buy that cookbook, 72 Ways to Prepare Alpo, and love it. But you have to do it on purpose. And getting out of debt in order to invest is the shortest way. And what is amazing to me is that almost the entire financial industry focuses on one part of the equation, and that's the investing part of the equation. And they all have a bunch of theories. Now, I've had all the letters and licenses after my name. I have a degree in finance. I've had all the licenses in the business. It is amazing the number of people in the financial world, whether they're financial advisors, writers, bloggers, whatever they do, that have opinions about money that don't have any money, and whose track record on teaching people to invest and getting them to invest sucks. 3% of the public is where all of those people make their money, off wealthy people. They make all their money off wealthy people. And most of the advisors out there won't fool with you if you don't have some money. They don't want to sit down and talk to you. And so we started teaching people, of course, all these years ago, how we invest. And then as we've met with many, many, many thousands of millionaires over the years, how did they invest? What are they doing? Well, we suggest, and I personally invest in good growth stock mutual funds. I spread it across 4 types: growth and income, growth, aggressive growth, and international. And I buy mutual funds that have at least a 10-year track record. Well, Dave, shouldn't you just buy index funds? Well, you can if you want. Index funds, basically an S&P 500 fund, mirrors the market. That basically is the stock market. And so you're going to do exactly what the stock market does, good or bad. The mutual funds that I buy outperform the S&P 500, and they're really not that hard to find. A lot of mutual funds don't outperform the S&P 500. So if you're going to buy that, well, that'd be dumb. Just buy an S&P 500. But I buy mutual funds that outperform the S&P 500, and my portfolio mix that I just outlined is pretty much always beats the market because I buy funds that outperform the market. It's not that hard to do. You open up the prospectus and there's 2 little lines on the graph. One of them is the S&P 500. If the mutual fund you're looking at, if that line is below that S&P 500 line, don't buy that fund. Duh. This is hard. Really not that much to this. But Dave, you just tell people buy those loaded funds. Yeah, they'll pay a commission. That's fine. Have somebody in your life helping you do the investing. All the data says that you'll continue to invest doing that. But when you're out there by yourself with all your theories and some idiot newscaster comes on the evening news predicting the end of the world, what do? You cash out all your mutual funds at exactly the wrong time because you don't have anybody in your corner saying, don't jump, don't jump. Instead, you're just out there with your own emotions and the newscaster. And that's how you pick out when you jump in or out of the market. And that's just dumb. So all the data says a decent portfolio of good performing mutual funds wins. And the big thing is actually putting money into the mutual funds, actually investing. One piece of research shows that 74% of the reason of retirement success is doing it. It's called savings rate. The number of you that put money in versus talk about it and continually put money in. Year after year, year after year, year after year, month after month, week after week, out of your check, into your 401k, over and over and over and over and over again. This is how you get wealthy. It's ludicrous. I know a lot about mutual funds. And let me tell you how I pick mutual funds. About 80% of the choice on my mutual fund, 85%, is based on its rate of return, its track record. If the track record's tied, and I'm trying to look, I look for the longest track record. Who's been doing it a long time? I like neighborhoods with big oak trees when I'm buying real estate. You see what I'm saying? I like a long track record. Something stable. I don't like risk. I like to make money. Risk equals not making money for me. Big risk, anyway. We should spread it across 4 types: growth and income, growth, aggressive growth, and international. Let's talk about those for a second because there's all kinds of names for mutual funds, and the name of the mutual fund tells you what is in the fund. Okay. A growth and income fund is also called a large cap fund, sometimes also called a blue chip fund. Now, the blue chip is the most expensive chip on the poker table, so that means these are big companies in this. Large cap is short for large capitalization. Large capitalization means these are large companies. And so your growth and income funds are large companies. Boring. Of the 4 types of mutual funds that I put money into and I recommend, this is the calmest. If you were to chart this volatility on this fund versus the stock market, you would see it's a lot calmer than the market. And so it's your friend when things are going down, in other words. It's your stable. It's the big old dinosaur companies. They're boring. When things are going up, by the way, it's also boring. It's not exciting when things are going up. It's a downer. You look at that thing going, why is it not doing well when the rest of the market's going up? Because it goes slower than the market up and slower than the market down, because this is stable land. A growth fund is right in the middle. The S&P 500 index fund would be considered a growth fund. A growth fund is companies that are growing. They're kind of medium-sized companies, so you might hear it called mid-cap fund. These are just standard growth stock mutual funds. There's a whole lot of these out there. Ton of funds that fall in this area. The idea is pretty simple. The growth fund, that's kind of right there in the middle. You want something in the middle. It's pretty much going to do about what the market does in terms of volatility, but you can get mutual funds that are growth stock mutual funds that outperform the S&P 500. You can even get growth and income funds, even though they're not as volatile, that outperform the S&P 500. Then there's the aggressive growth fund. This is the wild brother, okay? It's the crazy one. And so you might guess it's going to be also called a small cap funds. These are the small companies, the startups. A lot of tech companies would fall into there. Very crazy. All the fun, weird stuff is in there. And that means some of it fails and goes to zero. And so it's a crazier mix. It's going to be much more volatile than the stock market is. So it's going to go up faster than the market goes up, but it's going to go down faster than the market goes down. Small cap, aggressive growth stock mutual funds, also known in there as emerging market. You would call it that too as well. International funds means that the stocks in it are overseas companies. They're not American companies. It has a kissing cousin called a global fund. If you think of a globe, what is it? It's everything. So that would have international and U.S. companies in a global fund, and it would be a cousin to an international. By the way, American companies generally outperform other international companies by and large as a group, and so your international fund will be your worst performing of the 4 over the last several decades. And a global fund will outperform an international fund because you put some spice in there, you put some American companies in there usually, and so they're a little bit better, but at least you got some stuff overseas. You're not 100% betting on the American economy. Not that I'm anti-American, I am not. This is not a patriotic thing. This is a diversification thing. And so, you want to have some BMW and some Mercedes in there. You want to have some LG and some other stuff. Even though some of those things are made stateside, those are foreign companies. And so you look for companies that are overseas based, could be a French company, could be whatever, that are in an international fund. And then you spread your investing across those 4 types. Very simple here. The thing is, do it. That's the thing. Everybody talks and talks and talks and talks and talks about investing. The problem is nobody does it. People we talk to on the Millionaire Theme Hour that are millionaires, you know how they got to be millionaires? They did it. And they never, when I ask them how they became millionaires, they never say, oh man, I hit the home run. They never say that because it never happens. Oh, Dave, I hit the home run. I got this mutual fund that went straight up and I made all my money in one good buy. My golfing buddy gave me a stock tip. I don't meet millionaires that did that. I hear stories about it, but a golfing buddy with a stock tip is like a golfing buddy with a fishing story, the one that got away. I mean, it's just everybody's got an opinion and it's all a bunch of crap. And so you just have to really stop and go slow and steady. Actually investing is the way. It's the way. It's the only way to go. So growth and income, growth, aggressive growth, international. Don't chase the returns. Do not invest money in things you do not understand. People get ripped off when they invest money in things that someone told them is good and they trusted the person instead of knowing what the flip they were doing. All these athletes you read about, the NFL stars, and they lost $10 million or they made $100 million and it's all gone. And you know how they lose their money? Because they give it to someone else to handle and they don't even look at it. And then they're shocked to find out that person was a crook. That's how you lose your money. It's your money, just like it's your kids, which means you have to make it behave, just like you have to make your kids behave. You have to do that. If you want good kids, that's how it's going to happen. If you want money, this is how it's going to happen. You have to understand it. Now, you don't have to have a master's degree in finance. This stuff is not rocket science. It is really not that difficult. And you really, really seriously have to do this, and you have to understand what the money is going into. Do not put money in it. That's why when you're buying insurance, when you're getting a mortgage, doing your investing in mutual funds, that's why when you do all of that you have to understand what you're doing. And the only way you're going to do that is when you're picking someone to help you in one of those areas. You're doing your estate plan if it's complicated. You're doing your taxes if they're complicated, that kind of thing. You need someone sitting on the other side of the table that is not a salesperson, but they have the heart of a teacher, not the heart of a salesperson. I'm an easy sale once I understand something, but until I understand it, I'm not putting a dime in it. I'm not going forward with this. It's that simple. It's that simple.
In the 1940s, 1950s, radio was how America was entertained. Television was not widely distributed at that point. Families would gather around the drama, the series, like they gather around Netflix now. And so it was drama on the radio. One of the radio shows was a show in Chicago, and it was Sky King. Now, if you keep in mind, this is the 40s, airplanes were still a big deal. It was a cutting-edge technology to fly still. And Sky King was this guy with a great baritone voice. Of course, he was a radio voice. And he would fly in whatever the drama was, and he was the guy that would save the day. And the voice behind Sky King was a guy named Earl Nightingale. And Earl pretty quickly realized there was no money in radio, and he bought an insurance business, a general agency. And every Monday morning, he would have a sales meeting and pump up his sales guys and send them out to sell insurance. And he was very, very successful at it, all the way up into the late 50s. And one of the things Earl loved more than motivational speaking or jacking up his sales guys and getting them ready to go out and sell insurance was he loved to fish. And Earl decided he was going on a fishing trip in Canada. Well, his sales manager came to him and he said, you understand that the 2 weeks that you're gone, sales are going to go down because when you get these guys wired up on Monday morning, they're ready to go attack the world, and they go out there and make sales without you here to do the pump up, the halftime speech for the football coach. They're not going to do their thing, man, and sales are going to go down. Well, Earl thought, well, that's not good, but I'm going fishing, so I got to figure this out. So he goes back to his old radio days and decides he's going to record a talk. And he goes into the studio and records a talk just for the 2-week vacation. And the way you did a recording in those days in a studio was not tape. It was on an acetone record, a real floppy, real thin looking record. Any of you old enough to remember getting a record on the back of your cereal box, that kind of a thing. There's a little thin, flimsy record. It was meant to play 3 or 4 times and 5 times and then not meant to work after that. It didn't have a long shelf life. It was a short recording. And he went in and he recorded a 33-minute talk. They played it, sales went up while he was gone. They played it the next week, sales went up again while he was gone. He came back. By the time he had gotten back, everyone who sold anything in the entire Chicago area was abuzz wanting a copy of this talk. He ended up recording the talk formally, pressing records, and selling the records. And as best we can determine in research that we've done in the broadcast world, this is one of the records that sold beginning in 1959. This is the first recorded talk, not music, but the first talk of any kind to sell 1 million copies. The talk was called The Strangest Secret. And in it, he talks about the strangest secret is simply that you become what you think about. Now, this is a biblical truth. In Proverbs, it says, as a man thinks in his heart, so is he. Ralph Waldo Emerson said, a man becomes what he thinks about all day long. It turns out that what we focus on, what we concentrate on, what we think about, we tend to gravitate towards, move towards, become that. And if it's good or bad, we're going to be pulled magnetically in the direction of the things we think about. You become what you think about is the strangest secret. As a man thinketh in his heart, so is he. Henry Ford once said, if you think you can or you think you can't, you're right. Now, this was proven several years ago, and this is another old story that I just love, and it was proven in this instance. Now, any of you remember the book or the movie Unbroken about Louis Zamperini? He was a track star, and he goes into World War II in a Japanese concentration camp and finally gets out later. The story of his whole life is a wonderful story. Big old long book, Unbroken. The book's better than the movie usually is, right? So Louis ran in the Berlin Olympics with the Nazis doing this. Hitler is coming into power. And he was a miler. He was a kid from California. And in the Berlin Olympics, Louis ran the mile in 4 minutes and 21 seconds and just barely missed a medal. The miler that year was a little over 4 minutes. That was 1936. By 1954, no one had broken the 4-minute mile. No one. A guy did a 4 minute and 1 second, and it stood for 9 years. It was widely thought and taught that the human body, the physiological condition of the human body, it was impossible for anyone to train enough to go fast enough for the human body to cross a mile in under 4 minutes. If you think you can or you think you can't, you're right. You become what you think about. One doctor even prophesied that if someone actually did run a mile in under 4 minutes, that their heart would explode and they would die right there. Until 1954, Roger Bannister, famously, is the first human being, and that's a picture of him, to break the 4-minute mile, 3 minutes and 59 seconds. The record lasted 46 days. 22 people broke the 4-minute mile within the next 6 years. I've told this story and I love it, so much so that the watch that was used by the old guy sitting there in the trench coat as Bannister went across the line went up for sale on Sotheby's auction house in London. Well, apparently I've got too much money because I decided I needed that watch. What a great story and what a great thing to have in my safe for my kids to fight over after I die. So I go to bidding on this watch. I set myself the limit of $10,000. I was going to go no more than $10,000 to buy this world-class keepsake. I quit bidding at $38,000. I bought this one on eBay for $4, okay? But if you think you can or you think you can't, you're right. The power of intentionality. I'm going to be intentional about my life. I'm going to be intentional about my spiritual walk. I'm going to be intentional about the dimensions and the compartments and the departments of my life. You know, no one accidentally wins. You don't interview the guy after the Super Bowl and the little reporter runs over to the athlete and goes, how did you just win the World Series, the Super Bowl? They never say, I don't know, I just got off the bus. Now, I've been training since I was 6 years old. It's an intentional act to win. The power of intentionality goes with the power of belief in what we in our Christian walk call faith, what we believe. And we just did 2 years ago at Ramsey, the largest study of millionaires ever done in North America. We studied 10,167 millionaires, in-depth, airtight research because we knew people wouldn't like the results. Because we kind of knew some of the things we were going to find. And we knew that some people wouldn't like it. So we were really careful. We had outside research firm help us with the details and the control groups and the processes. If you know anything about research, it's a very detailed thing to do it properly and not get confirmation bias and these kinds of things in there. Detailed thing. Here's the interesting thing. If you get somebody to say something, if like 60% of the people say something in a group like that, that's called statistically significant, right? Over half of them say this. 97% of the millionaires that we talk to, when we ask them, can you become a millionaire today? And when you first started, did you believe you could become a millionaire? 97% said yes. If you think you can or you think you can't, you're right. When we interviewed the general public that weren't millionaires, do you think you can become a millionaire? 69%. Still a lot, but significantly less than 97% said that they thought they could. I wasn't planning to write another book this year for sure, but I got aggravated by two things that kept popping up in my face. One is I've been teaching these biblical principles to get out of debt, save money so that you can become wealthy, so you can be outrageously generous. Managing money for God, God's ways, and for your family is part of God's ways, right? And I've been teaching people this stuff for 30 years. And we call it the baby steps. You walk up the baby steps, you get out of debt, build your emergency fund, start your retirement, your kids' college, pay off your house, your baby step 7. Woohoo, we're free. We did it, okay? And we walk them through the baby steps. And I kept running into people all over America, wherever I went. And they would walk up and they go, hey, Dave, I've been doing your stuff for like a long time. Like, I'm old. Like, I've been doing this 25 years. I've been listening to you. And I'm a baby steps millionaire. And I did it. The stuff you teach, I did it and it worked. And I'm a millionaire. And I kept running into these people everywhere. And then I was running into, I do a lot of media stuff. And God help me, I actually sometimes look at social media. And I kept seeing out there the hope stealers. Y'all ever seen the hope stealers? The people that will steal your hope, that tell you it can't be done. They're the ones that, Eeyore is their spirit animal. Oh, it's bad. America's over. You're never going to be able to make it. It's bad. The little man can't get ahead. And I was running into these hope stealers everywhere, and they're telling me no one can do it, and sophisticated economists who were hope stealers, and people in the media that were hope stealers, and I'm talking to baby step millionaires who go, Dave, I did it. Hope stealers are out there. The first thing they tell you is this: all the rich people have all the money, and the only way you get rich is to inherit your money. You heard that one, say yes. Well, here's the thing. That's a lie. No, I mean, I've got data, facts, not your broke brother-in-law with an opinion, facts. Okay? When we study these millionaires, 10,000 of them, 79% received precisely 0 as an inheritance. That's 8 out of 10. 5%, when they did get an inheritance, it was a little one, like $4,000 or $5,000, which does not make you a millionaire in case you didn't know the math. Another 5% received a big inheritance, like a couple of $100,000 after they were already millionaires. So that didn't make them a millionaire. 5 and 5 and 79 is 89. That's 9 out of 10 millionaires in America today did it themselves, first generation rich with the blessings of God. Your whiny little friend says, but it's just not fair out there. It's not fair out there. The fair's where the tilt-a-whirl is in the prize pig. It's not fair. Oh, it ought to be equal. Equal is fair. Not in the Bible. And by the way, equal's not fair. If you work 100 hours a week and the guy works 10 hours a week, you should get paid more. I got a face for radio. I got friends who are pretty and they're like on TV and stuff and they make more money because they talk to more people than I talk to. That's not fair. I'm in Nashville. I've got all these music friends. I can't play. I'm in talk radio for a reason. I got all these music friends and they sell 10 million albums. I've never even seen an album except one I put on the record. It's not fair that they make more money at albums than I make. Of course it is. They serve more people. They help more people with joy than I helped with that. If I sell 10 books and help 10 people get out of debt, I should make one set of money. That's fair. But if I sell 10 million, I should make another set of money. That's fair. Fair is not equal because effort, talent, education, bothering to show up is not equal. So don't let the whiners tell you, well, the system's rigged. So I got to meet Condoleezza Rice. This woman is incredible. We were doing a leadership event. She came in to speak with us. She's unbelievably smart. Her purse is smarter than I am. And the woman, competition ice skater, world-class concert pianist, second woman ever to be Secretary of State, first black woman ever to be Secretary of State, provost of Sanford, grew up in a lower middle class family in extremely racist situation in Birmingham, Alabama. In those days, they called it Bombingham because that's when all the bombing was happening with the racism. But she wasn't defined by that. She didn't say the system's rigged. Is racism real? Oh, yes, racism is real. Is sexism real? Oh, yes, it's real. We don't all have the same starting point from where we got to go. We don't all have the same starting point. And that's not fair. It just is. But Condoleezza said her parents, what they taught her was that it doesn't matter where you come from. All that matters is where you're going to. I started a little further back. I'm from Antioch, Tennessee. I'm not from one of those cool families. I'm just a redneck hillbilly. So I started a little further back. Some people started further back than that and they passed me. Did you know every single demographic, every single race we found in the study had become millionaires? Someone chose to go from where they started to believe, I'm going to be intentional. If you think you can, if you think you can't, you become what you think about. I'm going to aim at this. As a man thinketh in his heart, so is he, and I'm going to go do it. And then there are hope stealers among my brothers and sisters in Christ. The ones that are oversaved, you know them. Christians shouldn't be wealthy. As a matter of fact, the Bible condemns the rich to hell. Have any of you heard this? Have you ever even thought it? I used to think it because I kind of grew up in an area that was all Christian. I'm in Nashville. There's more Baptists there than people. And yet the scripture actually says this, and you shall remember the Lord your God, for it is he who gives you the power to get wealth. The Bible does not say money is the root of all evil. It says the love of money is the root of all evil. Well, Dave, you know, Jesus said a camel can't get through the eye of a needle, so a rich man can't get into heaven. One of my pastor buddies says, don't let the world teach you theology. And I'll help you with that. For goodness sakes, don't let Twitter teach you doctrine. The most quoted scripture by the angry unbeliever Christian hater, don't you know that the rich aren't going to heaven because a camel can't get through the eye of a needle? All you got to do is just finish reading the context. And Jesus goes on down because the disciples were amazed. He said, well, who then can be saved? And he says, no one gets to the Father except through the Son. Let me just be mean to you. Are you ready to be mean? Because it's a spiritual gift, okay? So let me just be mean to you. If you believe with your toxic political beliefs, or you believe with your toxic upbringing in Christianity that rich people aren't going to heaven because of that scripture, let me help you with that. That's what theologians call heresy. And let me help you with heresy. Heresy is when what you're saying is prostitutes can go to heaven if they ask Jesus for forgiveness. Drug dealers can go to heaven if they ask Jesus for forgiveness. Murderers go to heaven if they ask Jesus for forgiveness, but not those rich people. Jesus' blood is not strong enough at the cross for those rich people. That's called heresy, technically speaking. So don't practice in heresy on Twitter, okay? It's bad for you. There's a lot of stuff on Twitter that's bad for you. So just helping you with this. With the evil 1%, they have all the money. They shouldn't have all the money. Oh, God, here we go. Okay, I'm a math guy. So here's the thing. If you make $39,000 a year, household income, you are in the top 1% of income earners in the world. You are officially going to hell. Well, this is how absurd this line of critical thinking is when you take your religion and you make it toxic to justify your victimization. Don't do it. I'm going to be intentional about winning the Super Bowl. I might have a harder start. It might not have been good when I was growing up. People might be mean to me because of reasons they shouldn't be mean to me, but it doesn't matter. I'm still going to go win the Super Bowl. I'm still not going to quit. The Bible teaches cause and effect. We reap what we sow. If you plant corn, you will water it, put fertilizer around it if you're a farmer, hoe around it, keep the weeds out, and then you will get corn if God chooses to send the sun and the rain. Now, St. Ambrose said we have to work like it all depends on us and pray like it all depends on God. The Bible is a constant dance between our faith in God and His provision and our faithfulness getting off your tail end and doing the work. So if you want some corn, you should plant corn. Aggravating Christians pray over mud holes that got no corn in them and can't figure out where the corn is when they have planted no corn. That's aggravating because it makes Christians look stupid. Corn come forth. It's not going to. You're supposed to reap what you sow. Sow the corn will come. Lord, I pray for money. Try saving some. I'm joking around a little bit, but we've all heard this stuff, and somehow we have to push back about it in our culture. I do believe God is a God of provision. He's a God of grace. I've walked in so much grace, and among all the dumb things I've done in my life, He's been so unbelievably good to me. It makes me cry every time I think about it. And I'm not in any way dissing that. I'm not in any way taking credit for success. But you have to work. And those that don't work, Paul said they don't eat. And somehow we get these things all twisted up and somehow spiritualize our inactivity or the fact that we're paralyzed and we're overwhelmed and we're scared and we don't know what to do. And instead of plowing through that and busting through that and saying, someone take my hand and help me out of this hole, and your brothers and sisters come alongside you, lift you out, give you a shot at something, the community comes around you and loves you well. All these things are scripture, and they all come together to cause us to be able to cause these things to happen in our lives because we learn to plant new and better things into our life. And I have a thing I call the displacement theory. I learned it from my wife. My wife is kind of like Pastor. She's kind of a health nut and like she's in perfect shape. She has zero body fat, which is simultaneously wonderful because she's my wife, but look at me, it's also shaming, okay? So she goes and walks her 6 miles or 28 miles or whatever she does in the morning and works out 4.5 hours or whatever the thing she does. And then she comes in and puts stuff in a blender that humans should not ingest and thinks it's fun. And when she pours it into a glass, it looks like nuclear waste. And it's good for you. Ugh. And then she's got this little nuclear waste mustache and says, do you want some? And I'm like, no. And she finishes drinking that nuclear waste and sets the glass in the sink, turns on the hot water, and the hot water goes into the junk. And the clean water, as it runs, begins to displace the trash. And if you let that glass, and you've done it before, that pan sit in the sink and just let the hot water run on it, it will boil the stuff out. And in a few minutes, the clean has displaced the filth. You put good stuff in, you will have good stuff in. And it will push the trash from the past out. It will push the past out. People from my neighborhood, I don't care about your neighborhood, put some clean in. People that grew up like, I don't care, put some clean in. People that don't have a chance to start it like, shut up, put some clean in. As a man thinketh in his heart, so is he. If you think you can or you think you can't, you're right. You can do this. It's called hope. Hope deferred makes the heart sick. Be not conformed to this world. Don't be like them, but be transformed. How? Displacement. The renewing of your mind. New things coming in. And it creates a new you. Whole new way of looking at things. Sharon and I have been married almost 40 years. I'm really glad. And she's really glad she ain't married to the guy she married. He's not perfect, but he's a whole lot better than that idiot she married 40 years ago. Displacement. I'm getting better. I'm getting better. Give me 40 more. I'll probably get it down. So what God wants for you is what I want for you. He wants you to get on a budget because Jesus said, don't build a tower without first counting the cost, lest you get halfway up and you're unable to finish. And all who see you begin to mock you and say, this man began to build and was unable to finish. You get on a budget so that you can live on less than you make because a foolish man devours all he has. You live on less than you make so you can get out of debt because the rich rules over the poor and the borrower is slave to the lender. You get out of debt so you've got money to save for an emergency because in the house of the wise are stores of choice food and oil. You're feeling the displacement yet. You take the savings that you begin to build up, that emergency fund, you're ready for a rainy day, and then, of course, then you're ready to build some wealth, and no discipline seems pleasant at the time, but it yields a harvest of righteousness. You can become a baby steps millionaire, and as you become wealthy, you can change your family tree because a godly man leaves an inheritance to his children's children. And then as you do that, you become outrageously generous because God loves a cheerful giver. By the way, that's the end of the game, and that's the beginning of the game. Outrageous generosity. The rest of the stuff in the middle is just how we get it done. I don't go to the supermarket very much. My wife, bless her heart, she does that most of the time. But when I do go, I'm kind of an efficiency expert. It's kind of a NASCAR pit stop for me. Closest parking spot. Once I get my stuff, I'm scanning the lines. Have you ever done this? Okay, that line's a little longer, but that one checking out seems like she's got her stuff going. I'm gonna get a little longer line. We're gonna get through there because I'm picking the fastest line to get in and out. The whole game is in and out quick. Y'all with me? Anybody do this but me? So I go in there the other day, and I love generous people. Generous people make us smile. Generous people make our eyes leak, don't they? And I go in there and I pick out the line, and there's this woman in the line, and she's got 2 kids who are everywhere, over everything. Y'all know what I'm talking about. I'm old school, bothering Papa Dave here. And then she's got these groceries, and she hands the guy her card, and it's rejected. Well, I hate to admit it, I was not looking compassionately upon this woman at first. I'm standing about 3 back. And now when the card comes out, now that's the business I'm in, right? Helping people that the card's rejected. And then I start looking at the kids a little more careful, and their clothes aren't very good. And then I look at her, and the windows are the eyes to the soul. The eyes are the windows to the soul, I'm sorry. And she's not having a good week. She's not having a good year. You can see the pain. You ever done that? You look at somebody, you see it stripping off of them. And then she hands them another card, and the card is rejected. And this whole thing is going down fast. Now, I'd like to tell you that I was the generous one, but I was slow on the trigger because it took me a minute to recover from my initial self-righteousness. But standing right behind her was Superman. Now, I didn't realize it was Superman because he was dressed like a Hispanic construction worker with mud on his boots. But suddenly, Clark Kent comes out, and he reaches up and pays for her groceries. She starts crying. Register lady starts crying. I start crying. I'm not even involved. And she's trying to say, no, 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 no. He can't understand anything. He speaks only Spanish, but he does speak card denied. He does speak having a bad year. $300 goes up, and he pays for her groceries. This is why we do what we do, because you won't be that guy. Generous people make our eyes leak. Generous people make us smile because we get to see God show up in the line at the grocery store. Put yourself in a position to be Him for the rest of your life. And try not to be self-righteous like me and beat Him to the punch. Put yourself in a position to be outrageously generous. And then if somebody that's crazy is drinking haterade because you became wealthy and you're incredibly generous, just tell them to have another serve. It's all good. Drink your haterade. Me and God, we're walking in generosity. He's letting me do this. It's the privilege of my entire life to be able to help others with money that He allowed me to manage. You can do it. As a man thinketh in his heart, so is he. If you think you can or you think you can't, that's faith or the lack of it. You'll be right either way. Decide. You become what you think about. You become what you think about. You become what you think about.
How many of you grew up like I did? Not rich. Now, I'm not theologically or philosophically shallow enough to tell you money will make you happy. Money will not make you happy. You get more money, it will make you more of what you are right now. If you are miserable and you get money, you will be lots of miserable. If you're a jerk and you get money, big jerk. And it'll mess with your family too. So money is not going to solve your problems. It's going to make them bigger. It's also going to make your opportunities bigger. If you're a generous person, your generosity will go into overdrive. You'll be outrageously generous. And you get a lot of money, we'll call you a philanthropist. Cool word. That means you give a lot of it away and you have a blast doing it. You found the most fun you'll ever have with money when you find that. So we live in a cause and effect world. What you plant, you will harvest. You will reap what you sow, right? So if you plant stupid, you will get a crop of desperate. I've done it. And if you plant corn, don't be looking for beans to come up. Don't be shocked by, because what you put into your life is what you're going to get out. So we found that there's 5 things that if you do these 5 things with money over a period of time, like 10 or 15 years, you will build a level of wealth 100% of the time. And now I said a level of wealth. I don't know what level because I can't predict car wrecks and cancer. I can't predict tragedy. And I don't know what your income will be. But if you're working and you do these 5 things, you will build a level of wealth 100% of the time. And this is not some prosperity thing, and it's not mystical or magical. When I cover these 5 things, they're all common sense. But common sense is so rare now, it's like having a superpower. So let's look at the 5. The first one is get on a budget. A written plan. You have to do a budget on paper, on purpose, before the month begins, every month. If you worked for a company called You Incorporated and you manage money for You Incorporated, the way you manage money for you now, would you fire you? Don't answer that. We misbehave with money, and so we're disorganized. We don't have a plan. Nothing's written down. Decide. The interesting thing about each one of these principles is you can just decide today to do them. I had a guy working for me, and he was not doing his process right, and I sat down, I said, this is what you need to do. And he goes, well, it's not the way I do it. And I said, change. And he said, well, I'm not like you. And I said, change. You can decide today to be good at this or leave. You can decide. You can decide to do a budget today. Get out a yellow pad or go free budget online, everydollar.com. You can decide today.
I'm going to start managing money well today. Because you're going to keep getting what you've been getting if you keep doing what you've been doing. You know this, right? Sowing and reaping. And the second one is you need to get out of debt. Now, we know this one. You knew Dave Ramsey was going to talk about getting out of debt because you know the Bible says the borrower is slave to the lender. It's real. Now, here's the deal. Think about this. Your most powerful wealth building tool is your income. Let me show you what slavery looks like. This week, they came out with new data that shows that the average car payment in America today, according to the National Auto Dealers Association, is $499. That's dangerously close to $500. You take $500 a month and invest it from age 30 to age 70 in a decent growth stock mutual fund, you'll have $5.6 million. That's what a car payment costs you. So who'd you make rich? General Motors, Ford, Lexus, I don't know, Toyota, who was it? You made somebody rich. It wasn't you. And you're driving along in something you can't afford, scratching your head and wondering why your kid's college fund isn't funded. Because we're giving it all to somebody else. And they have nicer furniture in their building, have you noticed? Something's going on here, guys. You know, and some people in here got a student loan that's been around so long you think it's a pet. You got MasterCard in your life. I mean, it's hard to be a slave if you don't have a master, so you might as well. We've discovered bondage and American distress. And it just keeps going and going. And I've done it too, y'all. I'm not picking on anybody. I'm just saying, here's the deal. Think about this. What if you had no payments? Can't even get my head around that. Well, you're always going to have a car payment. You know, I hear people say that. Little man can't get ahead. You're always going to have a car payment, so drive something nice. YOLO. Right? Which, by the way, is addressed in Proverbs. It says fool right after that. See, these are how we talk when we're losing. You know, you can't get ahead. I sure hope we can elect a president who will fix my life. Not going to happen. Neither one of them got the goods, I'll just tell you. You're in charge of your life. It's the only one that's going to work. And that's what changes. So how do you get out of debt? Well, you have to decide to not borrow anymore. That's the first step, isn't it? We had plastic surgery at our house. Had a plastectomy. Decided we're not borrowing money anymore. MasterCard. Capital One. What's in your wallet? Money. You're weird, Dave. You're right. And I'm not broke anymore either. I decided I'm not living like this. I hadn't had a credit card in 30 years. You don't have a credit card? I don't have a credit card. That's my wallet. It's got green presidents' faces. And it's got 4 pieces of plastic in here, 2 debit cards, one on my business, one on my personal account, which will do everything your stupid credit card will do. I travel more than any 2 of you put together. Shut up. It works, okay? Dave, you're not getting airline miles. Yeah, I've met a lot of millionaires, and none of them said, Dave, you know, I made it all on my airline miles. I hadn't heard that one, so I got my driver's license and my handgun carry permit. The third thing, once you're out of debt, then you need to be careful to foster high-quality relationships. What's that got to do with money? Everything. There's a huge correlation for those that build wealth and who they hang around with. Because you become who you hang around with. Have you noticed that? You don't let your kids hang around with little juvenile delinquents, right? If little Johnny down the street's a weed head, you don't let your kid run with little Johnny because you know you're going to have a weed head in your house, right? We know this. So they come home with that mouth on them, and you're going, where'd you learn that? I'll get you knocked in the next week in this house. Where'd you think you could get away with that? I'll take you out and make another one look just like you. You know, I mean, you know, it's because they're hanging out with little Johnny, right? You know what happens. We're the same way, y'all. We're the same way. You talk like the people you hang around with. You read the books they talk about. If you don't read and all your friends watch The Bachelor, well, here's a clue. Okay, here's what's going on. If this is all you know about is reality TV that's not a reality, probably we need to change our diet, you know? Read a book. And so Charlie Tremendous Jones said 5 years from today, you'll be the same person you are today, except for the books you read and the people you meet. Don't be deceived. Evil company corrupts good habits. And do you know this? The studies have shown that over a 10-year period of time that your income will become within 10 to 20% of the average of your 10 closest friends' income. Because you have the same habits they've got. You have the same diet into yourself that they've got. You'll have it. You can't stop yourself from doing it. You will become who you hang around with. And all the studies show that we have a tendency. Now, that's not to say I'm some kind of snob and I don't have any friends that aren't rich friends. Not that at all. I have lots of friends, but my closest hangs are people I want to be like. That's my closest ones. Now, I'll talk to anybody. But like when our daughters were growing up, they're grown and married to wonderful men now. But, you know, they're in high school and they're wanting to go on a date. We didn't do missionary dating. You don't get to date little Johnny the weedhead and lead him to Jesus. That's not going to work, okay? We're not doing this. Little Johnny could go to camp and get saved again. You know, we'll work on this, right? And so, You come up to our house, pick up one of our daughters, honk your horn. You better be delivering a pizza, all right? So coming in, talking to the old man, you know, I'll be cleaning my gun when you get home. You know the song, right? And so, this kind of thing. And I'm teaching them, Dad, all the boys in the youth group are scared of you. Good. Keeps away 2 things you don't want, baby doll. You don't want jerks and you don't want wusses. And if I can keep both those away, and then I can teach you how to keep them away, you can pick good. And guess what? They both picked good. They both picked good. They married studs, man. I got some son-in-law, unbelievable. Man, my sons-in-law are awesome. And it wasn't an accident. You see what I'm saying, y'all? You need to make these choices very, very carefully. The fourth thing is you need to save and invest. In the house of the wise are stores of choice food and oil. Wise people save money. That's what this means. And so it was used in the marketplace, like we use green presidents' faces, as a medium of exchange. If you had a carafe of oil, you were ready to do business. It was a sign of wealth. There were two classes of people, poor people and rich people. Most of the people were poor people. This is the Mediterranean. We're talking they ate hummus and olives, no meat. A little bit of bread, maybe a fish if they got some meat, but that was it. Rich people ate what we eat every day. Spices, good meat, Charleston food scene. You know what I'm saying, right? Cooking it up right. That's fine food. Stores of choice food and oil. Choice food and oil are symbols of wealth. So let's read that again. In the house of the wise are stores of money. By the way, the rest of that one says, and a foolish man devours all he has. If you spend everything you make, the Bible just called you a fool again. I've been a fool. Call me a fool too. And I decided to change. Wise people save money. Why? Well, to start with, we save for an emergency, right? Grandma said it. She said, save for a rainy day. It's going to rain. You're going to have a car wreck. You're going to lose your job. Something's going to happen. You're going to need some money. Dave, you need to be positive. I'm positive. It's going to rain. Something's going to come up. This one I don't understand. Unexpected pregnancy. Say what? Okay. But people come up with all kinds of things that are emergencies, right? Something's going to happen. And then you need to save and invest so you retire with dignity. You know, I'm going to spend everything I make and hope the government, which is well known for its ability to handle money, will take care of me. Dumb idea. I'm not even sure some of them have opposable thumbs up there. You know what I'm saying? It's just ridiculous. And we're counting on them in some whacked out kind of way to come be. They're not coming. There is no white horse. There is no Calvary. You're it, okay? You are in charge of your destiny. And that's great news. And so, all worried about the election, and I'm not worried about the election because I made money under both parties. Turns out it wasn't up to them in either case. I've lost money under both parties. None of them sent me a check. They all just want money. They're extracting like a tick, extracting blood all the time. That's all they do. This is the deal. The last one is all about generosity, but this is all about cheerfulness. Generosity is not just a transfer of funds. Generosity is a spirit where you decide to be a generous person. Generous people are more attractive. They smile. They're not grouchy. It's not all about them. They're the ones that open the door. They're the ones when the grocery bag has the bottom drop out and your groceries are rolling all over the parking lot. They're the ones out there helping you pick it up. These are the people that when they go out to eat, they leave a tip, you cheap and ridiculous. Well, I'm not one. I leave big tips because it's a form of generosity. Well, they didn't give me good service. Oh, shut up. They're carrying a tray that weighs more than you. Figure it out. They parked your car in the rain and in the heat. Shut up. Give them some money. They park your $130,000 car and you give them $3. What are you, a nut? That's Ferris Bueller parking the car there. You take care of that, man. I give them a $20 bill. My car's still sitting there when I come out. It's amazing. Besides that guy's working his way through college or something right then. If he says better than I deserve, that's his code for I'm getting out of debt. If they say that, you got to give them a double tip. So I give them 40. My wife's like, I'm going to park your car. No, you're not. You're not working your way out of college. You've already put up with me for 30 years, so it's all right. Generosity is a spirit. It changes everything in your life. But it's awful tough to give if you're broke. If you're in debt and you hadn't saved any money and you don't have a plan and you're not hanging out with other people who are givers. And so change. You get to decide today. It'll change your life. It'll change your family tree. You will change everyone with your last name that follows you if you do these things. It's that powerful. It's unbelievable. The sorrows are deeper and the joys are higher. It changes everything. And when you move this money piece around, it gives you the tools to be that in the marketplace and to be that for your family and to get this monkey off your back and to get that elephant out of the room because he's got to go.